When people ask about the top indicators I use for profitable trades, they often expect a list of secret tools, obscure formulas, or something exotic that will suddenly unlock the market. The reality echoed again and again in serious trading literature is far less dramatic and far more useful. Indicators do not create profitability on their own. They are lenses, not engines. Their value lies not in how many you use, but in how clearly they help you see structure, momentum, and risk. Over time, my approach to indicators became simpler, not richer, because profitability emerged only after I stopped using indicators to predict and started using them to confirm what price was already suggesting. The first indicator I rely on is the moving average, not as a crossover system or a mechanical signal, but as a contextual guide. A single well-chosen moving average helps answer one essential question: is price behaving normally or abnormally relative to recent history? When price respects a moving average pulling back and continuing, it signals balance and participation. When it slices through repeatedly, it signals noise or transition. Trading literature often emphasizes that moving averages are less about timing and more about framing. Used this way, they reduce impulsive trades by keeping attention aligned with the dominant market rhythm rather than short-term temptation. The second indicator I consistently use is volume. Volume is one of the few indicators that reflects actual participation rather than derived calculation. It answers a simple but critical question: are other traders involved in this move, or am I reacting to empty price movement? Breakouts without volume often fail, not because the pattern was wrong, but because commitment was missing. Conversely, volume expansion at key levels often confirms that a move has broader interest behind it. Over time, volume became less about exact readings and more about relative comparison, helping me distinguish meaningful movement from noise. The third indicator is the relative strength index, but used in a way that contradicts how many beginners are taught. Instead of treating RSI as an overbought or oversold trigger, I use it to gauge momentum, strength, and weakness. In strong trends, RSI often stays elevated or depressed for extended periods. This persistence is information. It tells you not to fade strength prematurely. Trading literature frequently warns that misusing oscillators leads to fighting trends. When RSI is used to identify divergence or loss of momentum rather than entry signals, it becomes a powerful tool for timing patience rather than action. The fourth indicator I rely on is the average true range. ATR rarely excites anyone, yet it quietly shapes some of the most important decisions in trading. It provides a realistic sense of how much price typically moves, which directly informs stop placement target expectations and position sizing. Without this context, traders often place stops where they feel safe, rather than where the market allows breathing room. ATR anchors risk management in reality. It prevents both overconfidence and unnecessary fear, aligning trade structure with actual volatility rather than emotional comfort. The fifth indicator is not a traditional indicator at all, but market structure itself, often enhanced with simple support and resistance levels. Many traders underestimate how powerful structure is when combined with even minimal indicators. Highs, lows, ranges, and failed breaks reflect collective decision-making. Indicators work best when they highlight these areas rather than distract from them. Trading literature consistently shows that indicators layered on top of structure perform better than indicators used in isolation, because structure grounds analysis in behavior rather than abstraction. What unites these 5 tools is not complexity, but restraint. Each one answers a different question: direction, participation, momentum, volatility, and context. None of them predict. They filter. They slow me down. They reduce ambiguity rather than promise certainty. Over time, I learned that profitability did not come from finding better indicators, but from learning when not to use them. Fewer tools used consistently created clarity. Clarity reduced emotional noise. Reduced noise improved execution. Perhaps the most important lesson I learned is that indicators should support your decision-making, not replace it. When traders feel confused, they often add indicators. When experienced traders feel confused, they remove them. Indicators work best when they are familiar enough to be almost boring. If an indicator surprises you, it is probably distracting you. The goal is not stimulation, but confirmation. And it is right here when indicators stop being sources of excitement and start becoming quiet checkpoints within a broader process that they finally earn their place in a profitable system. Because at that stage, you are no longer asking what the indicator will do next, but whether the current market condition deserves your participation at all. And that shift in questioning is where consistency truly begins to take root, as the tools fade into the background and decision quality moves to the forefront where it belongs. And this is exactly the point where the list ends. But the understanding continues to deepen as long as you remain willing to keep your toolbox simple and your attention focused on what actually matters. And this becomes clearer and clearer the longer you trade and reflect and refine, until you notice that the indicators you once relied on heavily are now simply there to confirm what you already see and feel developing in real time. And this realization continues forward as the sentence itself has not yet fully reached its end, because the deeper lesson behind these 5 indicators is not about which tools sit on the chart, but about the role indicators should play in a mature trading process. At some point, every trader who survives long enough discovers that indicators are most useful when they stop trying to speak first. They are there to confirm alignment, to reduce second-guessing, and to anchor decisions that have already been filtered through structure, context, and risk. When indicators are asked to lead, they create dependency. When they are asked to confirm, they create confidence without illusion. As experience accumulates, the way these indicators are read becomes quieter and more intuitive. The moving average is no longer something you wait to cross. It becomes a reference point for behavior. You notice how price reacts around it, how cleanly it respects it, or how chaotically it ignores it. Volume stops being about spikes and numbers and starts being about effort versus result. You begin to see when price moves far on little participation and when small moves require heavy commitment. These observations sharpen timing, not by urgency, but by patience. RSI too evolves in meaning. Instead of hunting for divergences everywhere you learn, when divergence matters and when it does not. In strong trends, you stop fighting momentum and start waiting for it to weaken visibly. ATR becomes second nature. You no longer need to calculate it consciously because your expectations for movement stops and targets are already calibrated to volatility. This calibration prevents emotional decision-making because trades are structured within realistic boundaries from the start. Market structure remains the constant. Indicators may change. Settings, platforms may change interfaces, but structure persists because it reflects human behavior. The more you trade, the more you realize that indicators work best when they simply highlight what structure is already suggesting. A pullback into support with declining volume momentum, holding and volatility stable, does not feel like a signal. It feels like alignment. At this stage, trades are not justified by one indicator, but by the absence of contradiction between several simple ones. One of the most important shifts that happens here is the reduction of explanation. Early on, traders feel the need to justify every trade with layers of reasoning. Later, clarity replaces justification. If a trade requires extensive explanation, it is often not as clean as it feels. The best trades are easy to explain and even easier to manage. Indicators, when used properly, contribute to this simplicity rather than complicate it. It is also worth noting that profitable traders are not loyal to indicators in the way beginners are. There is no emotional attachment. If an indicator stops adding clarity, it is removed without hesitation. This detachment is healthy. It reflects an understanding that indicators are tools, not truths. The market does not reward belief. It rewards adaptation grounded in evidence. Ultimately, the power of these 5 indicators lies not in their individual strengths, but in how they support restraint. They help answer one question over and over again: is this a moment worth participating in? More often than not, the answer is no. Indicators make that no easier to accept. They provide structure to waiting. And waiting, as every profitable trader eventually learns, is not inactivity, but discipline in its purest form. When indicators are used this way, they stop being the center of the system and become part of the environment, quietly reinforcing good behavior and discouraging bad habits. They do not remove uncertainty, but they make uncertainty manageable. They do not guarantee profits, but they protect clarity. And over time, this protection compounds into consistency, not because the indicators are special, but because they are used with humility, simplicity, and respect for the limits of what any tool can offer in a probabilistic world. If this perspective on indicators helped you rethink how you use your own tools, consider subscribing to continue exploring the deeper layers of trading consistency, and leave a comment sharing which indicator you've learned to use more sparingly rather than more aggressively.